This region around the Great Lakes has been called a heartland. When it comes to agriculture, there's hardly an area in the world that compares.
Everybody, just hold on. I don't know what we're going to have here.
That's what brings the viewers back. That a boy.
Manage money, piling in.
Double digits higher.
So at this point, we're in kind of uncharted territory.
There's a lot of money on the sidelines.
So that was a crazy one.
Good morning, everybody. It's Tuesday, July 15th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to them during the show. Overnight markets here at September corn down 4 at 396. August soybeans were down a penny and 3/4 at 9.99 1/4. And September Chicago wheat was down 3 1/4 at 5.38 1/4. No export sales announcements here this morning, so we'll jump right in. Yesterday afternoon, we got weekly crop conditions. Corn stayed steady in the good to excellent category at 74%, still well above the average of 65%. Soybeans, I guess, to some surprise, quite a big jump in the good to excellent category, up 4 points to 70% good to excellent. And again, well above the 5-year average of 62% there. Spring wheat also improved 54% in the good to excellent category against 50% last week. Still slightly lower than the average of 56%. And winter wheat harvest is 63% complete. It was a good jump, 10% over the week on week, 53% last week, and then just pretty much right in line with the average, 64% there. We had CPI data here this morning, was much in line with estimates, up 0.3% on the month, putting us at 2.7% is in terms of our CPI there. So inflation upticked a little bit, but as expected, outside markets not really doing much. The Dow is down 37 as we speak here this morning. We'll get NOPA crush out at 11, looking for 185.195. So we'll take a look there and certainly visit about that tomorrow in the War Room. Ben, I'm gonna put it on you this morning. What do you got for us here, man?
Yesterday we had reversal type of action. With a disclaimer, bear markets are notorious for giving you reversals and then ramming them back down your throat. So we'll see how that plays out this morning. Not out of the question to go back and fill that bar a little bit and see what happens. So on an optimistic point, I would say that. Russia, Ukraine bears watching. A complete flip-flop, whatever you want to call it, reverse of direction by Trump to move forward and support Ukraine. And that's a big deal when you're talking about, 12, if you combine Russia and Ukraine, it's 12% of global corn exports and 18% of global wheat, which wheat would put them, at the top of the chain there. So we have a situation that if it continues to escalate, and I know we've become immune to it following what happened in 22. We saw a dissipation of reaction from the headlines. But moving forward, if it were to truly escalate, I think that it could grab some attention kind of at a point in the year where wheat's always vulnerable to some short covering type of action after harvest, as well as much lower prices from where we started back a while back. So I think it bears watching. You have two of the probably larger egos in the world, maybe in the last 30, 40 years, and to see how stubborn they want to be in this area going forward. So I think that, that's kind of at the top of my head. We've played out and debunked a lot of the bearish narrative outside of the U.S. has a big crop, going to be a lot of bushels in the fall. So we'll just got to play it out and see what happens here. But I think that's a big change geopolitically.
Yeah, no doubt. Dustin, I guess interesting to see the bean crop conditions. And I know we've discussed crop conditions ad nauseum in terms of our opinion of them and what they're the overall scientific piece of the puzzle that they fill. But still, to see a 4% jump there, corn stayed steady. I guess, what are your thoughts here as we start the morning?
Yeah, I'm sure there's some in Twitterverse are going to start writing down a 60 bushel yield at this point. But, yeah, I mean, July 15th, it's hard to know what beans are going to yield. Like I think, one of the original mentors we had here would always say, don't really have a strong opinion on beans till you get into August. And I think that's always worked pretty well. Yeah, they look pretty good in a lot of areas. I actually, I guess, was a little surprised. I talked to a number of people in Iowa that thought that Iowa ratings would decline, at least just with the way things were shaping up and looking, but they were left unchanged. I think the market said it perfectly. Last night we gap opened lower on the news and then immediately put it back up. So there's some people that panicked on the higher ratings, but I think the beans are actually doing better than corn in the overnight session. So the other thing to think about beans too is oil share. So oil share, traditionally it's very hard for oil to be 50% of crush, right? So the last 2 days is first in a couple of years now that we have had lead month oil 50% of oil share, and we've got new crop crush margins continuing to rise as of this morning, $2.08 a bushel for November. So you think about that WASDE report last week, they raised domestic crush demand 50 million bushels, lowered exports 70 million. I think that makes sense. We're well within capacity when we have this many months of positive crush margins all the way out through the new crop window. Domestic demand should be very strong, and we don't know what we're going to get yet for yield. We have written down 52.5 on the WASDE report. Very easily we've seen a number of years where we top trend and it tends to be a record. That's certainly possible. I would not write down anything higher than 52.5 right now just because of weather year to date as of July 15th for beans. It's got the potential, but we still need to finish out August, in my opinion. So when you're thinking sub 300 million bushel carryout is very easy because domestic crush remains strong. And we have the potential for trade deals on the table if China comes, with any sort of a phase one type trade deal. I think risk reward of the market going down in this type of crush margin environment, domestic demand is going to remain strong versus holy cow, we have a trade deal. How are we going to satisfy that with the limited available supply that we actually have for export? The risk reward of the market going down or up for beans, in my opinion, is up if there's any sort of a trade deal signed. Now, of course, we get perfect weather in August and China continues to, be at the table and not have signed a phase one trade deal. We certainly can bleed lower, no question. But you now have a farm bill that's, I think, extremely friendly to the grower if prices stay low. We're going to get the higher of the PLC or the Arc County price. And those 5-year Olympic averages are quite high. So 5-year Olympic average for beans is 12.17. 5-year Olympic average for corn is 5.03. So on those base acres, if we're getting 88% of those numbers, that's high 10s for beans and that's mid 4s for corn. Anything below that, it doesn't matter if counties are out yielding it, growers are going to get paid the lower it goes. So I think that's one of the big things that is kind of holding me back from getting too bearish is that there's actually, in many growers' cases, there's financial incentives for prices to go lower. If you're in the money on crop insurance, you bought up a big revenue policy, a 95% policy, and yields are not like stunningly outpacing themselves, we're probably deep into a payment on the corn side and not far away from a payment on the bean side. So if you were to drop another 50 cents for corn, another $1 for beans, and you're going to see rising farm bill payments, and you've got just a few hedges in place, 10%, 20%, you're going to see more revenue at those lower price points for this growing season than you will if the prices stay where they're at. So it's a weird incentive to be in. We were in this same type of incentive for a lot of people in mid 2020, right around this time of year. And market, of course, turned around for many reasons, COVID, incentives, looser fiscal and monetary policy. And then, of course, the Chinese phase one trade deal that started to be adhered later in the year 2020 into early 2021 on top of duratio, of course. many things came out of the woodwork that no one was expecting back then. I wouldn't be surprised to see things that we don't expect either, whether that be trade deal or weather doesn't finish out perfectly. I don't want to go say on July 15th, slam dunk, beans are going to have a record crop. We need to keep selling them at this price point. Same for corn for that matter, even though, we've got a lot of water. So
on a daily basis, I think you highlighted a nice point, and we've touched on it a number of times. Right now, you're doing the deep dive on an individual basis with your growers that you work with, Dustin, to see, okay, let's take each of these different revenue components, whether it be farm bills, disaster payments, whatever, factor them all in. Let's take a look at what today we feel like is an acceptable yield range, right? And then say, okay, here's the picture. Take whether it's one deviation or whatever that math is that you want to look at current prices and say, okay, like, are these acceptable returns? What is our game plan? And then do you get the sense that that's offering some semblance of a clear mind to be able to make decisions, or what's your?
I think so. Yeah, I think it's changed a lot of the way our customer base is marketed this year. Yeah. Even though I wouldn't say clear mind, clear conscious that this is all going to work out the way that it's stated to. That's not something I can go and promise either, though, because the marketing year average is comprised of the entire marketing year. So by the end of December, we should be about 40% priced. By the end of March, should be 75% priced. So that's a cash price nationally, and it's calculated, accumulated through the months of that marketing year. That's not going to match up perfectly to any one grower, let alone growers that don't have any storage or growers that store everything to July. So you got to kind of be a little mindful that there is not a perfect lean on that, even though I think that the money that would be expected in a 360 environment, especially the marketing year average down there, it would be substantial, right? Substantial money as long as you have the caps open for it. But can we say, well, don't worry, lean on that? Absolutely not. I mean, I'll just give a quick example. A grower that has to sell everything at harvest, right? And think about 2020. This is exactly how 2020 went about. We were high threes by the time we got to end of harvest, which is certainly well off the low. 330, low 330s and 320s where we're at in the midsummer there. The PLC price was 370. So you factor for a national basis, slight under basis. Thought there's a decent chance for PLC payments for most of that season. Well, by the end of that May of 2021 contract, prices were well above $7. So if you even just in that example of how the price action went from a 380 price in the fall cash price to $7 for those that had put it in the bin and had not sold anything, that was both in the same marketing year. So we cannot count on, if you're selling 370 corn this harvest, that you're going to absolutely get a PLC payment. Things can change over the winter. And this is where the hard part's going to come in. If we're trying to lean on the protections that Farm Bill offers, lean on where crop insurance comes in, especially for most of these policies are county yield policies, which that they might not represent your own production. It's going to be a bit of a tightrope walk. It's not necessarily clear, but we know that they're out there, and we have to do it within the best of our knowledge. Try to lean on those where we can, because margins without these things are negative $150 an acre for a lot of high rent district growers right now. So yes, if we're at 370 corn, I'm pretty confident a lot of people are going to be made whole just from crop Farm Bill. But you got to be very careful that you say, okay, I'll just lean on that and then sell it all at 370, and then your neighbor's getting $5 next spring because of a drought over the winter in Brazil. That's not going to be a very good net outcome if that happened. So yeah, to your point, Dan, it's you gotta walk that tightrope, but you also need to be very careful not to lean too hard on them either. And that's why we're working with each person individually. The best thing you can do is get me your PLC yields, your PLC, your base acres for corn and soybeans, and then we make assumptions through the season. And then that assumption is going to need to be updated as we go through that marketing year average and we start to get that data this winter.
Yep. So again, take the time, do a little digging. You got a little time here for the rest of the summer before we get into the fall, and just be sure that you've got all your ducks in a row. We'd love to help you out there. Real quick here, Rye, big volatility in cattle yesterday, and continue to see kind of a technical selling, it feels like, in some of the hog complexes. So I guess, what are your thoughts here this morning?
Yeah, absolutely. Just kind of a big, huge break. Not exactly big and beautiful as some would put it, but you took back pretty much all of Friday's gains. I mean, open interest was still up here, so it looks like there was plenty of people just chomping at the bit to buy the dip here. But, you know, we've got no cash here right now. I think you got a lot of things culminating, like obviously beef prices are still sliding here. Choice down another $1.50 yesterday. Select almost down $2. So there is a little bit of caution right now. I would say you've got maybe a little bit of a buy the rumor, sell the fact as well. But on the other hand, you've got this big discount on the board to last week's cash. The market just, I think, just kind of keeps everybody looking at it and saying, hey, it's gonna go higher. You know, so we're just not out of the woods yet. I think in terms of that mentality, obviously the trade and managed money is still really long this market and willing to play a lot of defense. It's just hard to fathom that, you know, on a $6 break in feeders, $3 break in cattle, like, you really didn't do any chart damage. You know, we're still nowhere near any kind of moving averages. So there still is some pretty decent downside risk here before you actually start to see those numbers start to come to fruition. But I think a lot's going to be determined how Packers play this. If they are getting the squeeze, they're going to try to probably pick something up maybe earlier, possibly cheaper if they can. But I don't think anybody's really convinced that that's going to be the case. So I think we're just in it for maybe a steady kind of cash market this week. But I think the price action is going to determine that direction. So just keeping an eye on that for now. On the hog side of things, exactly, technical pressure. It just kind of feels like we're running into maybe a little bit of that seasonal decline here too. Just kind of, I'd say, just, you know, typically seasonally, we will stay on the defensive between now and August, possibly even a little bit later. But we are seeing cash markets hold up a little better than expected. It looks like technically we may be getting a little bit on the oversold side, so I wouldn't be surprised to see maybe some speculative buying here. But we did see a decent chunk of liquidation on the hog side of things, almost 6,000 contracts taken out of commitment here yesterday. So maybe the tide's changing a little bit. Some of the tariff rumors, you know, with our trading partners starting to kind of create a little bit of caution. But overall, it just kind of seems like cash markets holding up, but still seasonally, I think there's a lot of downside risk here in that alone. So just kind of watching that for now.
Very good. Appreciate the update here. We just came into the open. We got September corn now down a half at 399.5. August soybeans are unchanged. 10.01 is the last. New crop November is up a penny and a half there at 10.08.5. And September Chicago wheat is up a quarter at 541 3/4. Again, we're going to get Nopal Crush at 11 o'clock. We'll talk about those numbers here tomorrow morning. If you wouldn't mind, throw us a like and certainly subscribe. We appreciate everybody that tunes in on a daily basis. Subscribing doesn't cost you anything to do, so it'll keep you up to speed on everything that's going on with AgYield. So again, thanks to everybody that supports the show. We're doing this live every day that the markets are open on X, Facebook Live, and YouTube Live at 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good show. Hope everybody has a great day, and we look forward to talking to you again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.